Hi, I'm Rick Kaler. Thanks for joining me. The current annual U.S. budget, as proposed by President Obama, includes some significant potential changes in tax law. The proposals that have been put forth are many, but the ones I want to focus on today could result in higher capital gains taxes on inherited property, an end to most tax-deferred real property exchanges, and increased taxes on S corporation dividends. In the estate planning category, the President would like to end the step-up in basis rule and replace it with a mandatory sale at death rule. The step-up in basis rule allows property that has appreciated in value to be passed to an heir without either the estate or the heir having to pay capital gains tax. The heir's basis in the property, and the basis is the amount equivalent to a purchase price deemed the heir's initial value for tax purposes, is what the property is worth upon the date of death. Only appreciation from the date of death is then subject to any capital gains tax. Under Obama's proposal, the estate will have to pay tax on any capital gains as of the date of death. As I read the proposal, these taxes are in addition to any estate taxes. Let me give you an example. Assume your mother purchased an acreage 20 years ago for $30,000, and at the time of her recent death, the property was worth $500,000. Under the current law, you would receive the land with a new stepped-up basis of $500,000. Neither your mother's estate nor you would pay any capital gains taxes on the $470,000 gain. Under the President's proposal, your mother's estate would pay up to $88,000 in tax on the gift to you. The first $100,000 of gain would be excluded from taxation, leaving that much less to distribute to you and any other heirs. Even worse, suppose the acreage was your only property that you were inheriting, or the only property that your mom had of any significant value. It's conceivable that the estate would have to sell the property to raise money to pay the tax, then distribute the remainder of the sale proceeds to you. In effect, the new tax law could eliminate your ability to inherit the land and reduce the value of what you receive by $88,000. The next proposal in the budget is to cap any 1031 tax-deferred exchange of investment property. The 1031 is a real popular real estate tax planning provision where an investor can exchange a property for another like-kind property and defer the capital gains tax until the property is eventually sold for cash. Also, the proposal would completely end all like-for-like deferred tax exchanges for collectibles and art. The President would like to limit the deferred gain to $1 million in any 1 year. Any gain above the limit would be taxable at up to 23.8%. Since there's inherently no money changing hands in an exchange, the investor would have to have sufficient additional funds available to write the U.S. Treasury a check. I think this would effectively end the 1031 exchange as a tax planning tool for all but the smallest of real estate investors. And getting up to $1 million of value in a real estate deal is not difficult, especially in larger metropolitan areas near the coasts. Another disturbing proposal is to apply the 3.8%, I'll call it the Obamacare tax, which is a net investment tax for those with adjusted gross income over a certain threshold. To apply this to S corporation dividends. Currently, shareholders don't pay this tax on these dividends. The proposal would now tax all pass-through income as a self-employment income, subjecting S corporation dividends to the tax. Now, the chances for any of these proposals to become law in 2016 are remote. given that Congress is currently controlled by Republicans and we are in an election year. Yet, the proposals may indicate some of the revenue possibilities that lawmakers are considering and will consider in the future. These are things that are, so to speak, on the table. So it's a good idea to keep those possibilities in mind when considering your own estate and tax planning. Thanks for joining me.